What's up? I'm Austin. I'm a Tesla shareholder. I share my portfolio right here on the channel all the time, so check out my portfolio if you want to. But this video is about Tesla and why I'm excited to own Tesla in 2023. All right, so let's start off right here, right? The headlines, the news, right? Stocks up 4.66% today. Let's completely start ignoring day-to-day moves in stock prices. They don't matter for long-term investors. Over the last year, stocks down 71%, but even a year does not matter. In most years, this last year was kind of a crazy year. Most years, a year does not matter for investors, especially if you have a good process. 5 years, if we could just zoom out, 435%. 10 years, up 5,000% in Tesla, right? These are the time frames we want to invest in. So why am I excited about Tesla right now? Well, it's trading at 52-week lows, basically, and I don't look for stocks at 52-week lows, but if people are too excited about a stock and then it comes down and sells off when the narrative turns negative, the news turns negative, but the company is still performing, I start to get excited, right? We're not investors based off memes and news and what Elon Musk's gonna do. No, we are investors based on long-term fundamentals in great companies and companies that are gonna grow their earnings, grow their revenue, continue to innovate, produce market-beating and market-leading products, and outperform over the long term. That is what makes stock prices go up over time. And when you get an opportunity to buy them at good valuations, that's when I like to buy them. And that's where I think Tesla is right now. And we're going to talk about exactly why in the video, right? Okay, narrative. The narrative is negative. We see all these negative headlines. They just missed delivery estimates, right? Negative narrative is about as negative as it could possibly be on Tesla. Right now, we are looking at a chart that shows Tesla stock price right here, 108. You can see how far it's come down, and we are showing Tesla's sales growth over time. Over here, you can see during this, since 2009, their sales growth rate has been 51% per year on average. And that's revenue per share. Their normal price to sales ratio, which is a way that stocks are valued, is 9.85. During COVID and all the COVID craziness, got up to a price to sales ratio of 25, then a price to sales ratio of 27, and has since sold off down to a price to sales ratio of 4. I'm not using price to earnings or price to free cash flow right here because throughout most of Tesla's history, those weren't metrics we could actually use to value the stock, but sales were. And we can see back in 2016, before Tesla went on its insane run, it was trading on a price sales ratio of 5.3. We are now below the 2016 price to sales ratio for Tesla. And you don't see a price to sales ratio of 4 in Tesla almost at any point since it's been a public company. I don't know if it's ever really traded down, I guess during COVID, right? 3.67 when the whole world was ending. You are now getting an opportunity on a price to sales basis to buy Tesla at its lowest multiple, pretty much that it's ever traded at while being a publicly traded company. Okay, but we have to think about how fast has revenue grown in the past and if it can maintain that revenue and now earnings and free cash flow growth in the future. If it can't, then maybe it doesn't deserve to trade at as high of a price to sales ratio, and it should be trading at 4 or lower than 4. If we look at other automakers, if we want to compare Tesla to automakers, Ford is trading at a price to sales ratio of 0.3. Now, if you think Tesla should be valued like other automakers, you should never, ever buy Tesla because it trades at such a premium valuation, at least on a sales basis, to other automakers, right? So let's go back to Ford. Now we're going to look at earnings though, and we can see the blended price earnings ratio of Ford is 5.8 and Tesla is 26.6. So again, if you think Tesla is just like the other auto manufacturers, you should turn this video off and you're not interested in Tesla at all. But I think that yes, Tesla is an auto company. They make most of their money from selling cars. They have higher gross margins, higher cash flow margins, and higher margins across the board pretty much than any other automaker other than some of your premiums like Ferrari and companies like that. But they're also expanding into energy solutions, and everybody's talked about it, full self-driving and AI and robotics and stuff. I am a believer in that stuff, and I think there is value to that growth over time, right? Let's now start to look at some of the financial metrics that this company has put out. Some of their sales growth, their earnings growth, their cash flow growth. Let's start to look at that. There's a website called stratosphere.io. They have a free version, they have a paid version, and I love this website. You'll notice I use a lot of different websites. I was just using fast graphs. I'll call those out as I use them since I use them in my investing process, and I encourage you to check them out. Over the last 5 years, revenue has grown at 41% per year. Over the last 3 years, revenue has grown at 29% per year. So there is a slowdown. That's normal. As revenue numbers get larger, growth tends to slow down. EPS, earnings per share, over the last 5 years has grown at 43% and 69% over the last 3 years. And again, here's the margins, right? Gross margin, 26%. Operating margin, negative 0.9%. Net profit margin, 14.95%. And free cash flow, 11.89%. Let's just search and see what Ford looks like. Okay, here you go. Gross margin of 15%, net profit margin of 6%, and free cash flow margin of 4.9%. Now we're looking at GM, 12.89%. 6% operating margin, 0.77% free cash flow margin. And now let's look at Ferrari, which I think is a better comparison actually to Tesla. Gross margin of 49%, net profit margin of 19%, and free cash flow margin of 12.2%. Revenue 5-year growth 7% and then 8% over the last 3 years. So Tesla's growing so much faster. Earnings per share growing a lot faster for Tesla, right? And now let's look at this price earnings multiple of Ferrari, 36. Price to sales multiple of Ferrari, 6.8. So all of a sudden, Tesla doesn't look that expensive if they can maintain their growth and grow into new categories, which arguably Ferrari can't. I mean, almost not arguably, right? Like they are not making progress in electricity storage and robotics, and Tesla is. Okay, now let's check their revenue growth since 2013. Again, I mean, you're just seeing insane revenue growth, 58%. They've grown from $2 billion in revenue in 2013 to $74 billion in the trailing 12 months, the last 12 months. Another argument for Tesla is that they are improving gross margins. Again, all about profitability here. They are creating the capability for them to become more profitable over time by getting better at things like production, by introducing higher margin vehicles and then potentially full self-driving and energy solutions and robotics. This could all be higher margin stuff. We are seeing gross margin improve over time. 2017, we had 19% gross margin. Same thing in 2018. A dip in 2019 to 16%. 2020, 21%. 2021, 25%. And then the trailing 12 months, 26.6%. That is a trend we want to see in gross margin. When we look at net income, and this is, a measure of profitability, right? In 2013, they had minus $74 million in net income. Trailing 12 months, they had $11.19 billion in trailing 12 months net income. Just remarkable changes. If we look at that, that is a compound annual growth rate of 77%. All right, now we're looking at key performance indicators, which is another amazing feature about stratosphere.io. Again, love this platform and love this product. If you don't want to use it, don't want to pay for it, that's fine. Don't go there. Just watch these videos and you can get value from these videos. But if you're interested in this type of stuff in your own research, I highly recommend the platform. All right, auto sales revenue. Again, this is where most of their revenue has historically come from. So since 2013, compound annual growth rate, automotive sales revenue of 48%. It's grown from $1.9 billion to $62 billion over the last trailing 12 months, right? But now let's talk about some of those other revenue categories that, people that aren't looking deeply into Tesla may not be as familiar with. Let's look at services and other revenue. Services and other revenue has grown at 54% CAGR since 2014. And it's grown from $187 million to $5.4 billion in revenue. Let's talk about that energy sector, right? Energy generation and storage segment. This was another, type of revenue that they didn't have anything of until 2014, and they really didn't start, focusing on until 2017. You can see it was at 4 million and then 1.1 billion by 2017, and now we're at 3.2 billion. So their energy generation and storage segment revenue has grown at a compound annual growth rate of 137%. That growth rate is not going to continue at that pace, right? But what I want to do is just show that Tesla truly is more than just an automotive company. Automotive is still by far most of their revenue, and it will continue to be for a long time. But I think there is a future where potentially automotive is actually less of a portion of revenue than some of these other segments, and energy generation and storage could be a massive one. AI and software and full self-driving could be a massive one. Now, you're not going to get some crazy, insane price target for Tesla out of me. That's not how I think about this stock. I think if there's that much upside, great, but I'm going to have a logical valuation for my own self for Tesla. And how I'm going to get that is by just basing it off of, this is ticker, TIKR. I like this because it shows analyst future projections and what they're thinking, and then I can actually look at a compound annual growth rate. This is great to have if you're trying to build out some kind of discounted cash flow analysis, which is what we're going to do next using Stock Unlock. Okay, so we are now looking at analyst forward estimates for revenue, and we can also see cash flow and earnings, and we're going to use this to build our discounted cash flow model and get our prices. Okay, so they're thinking that revenue is going to grow at a compound annual growth rate of 28% through 2026. They're thinking it's going to have in fiscal year 2023, they're thinking they're going to have 34.8% in revenue growth. 2024, 27%, 2025, 16.5%, and then 2026, 14.1%. So that compound annual growth rate is 28%. But then we're going to do this off of our model based off earnings, right? So their normalized earnings per share are expected to compound at 23.6% through 2026. And so they get to growth of 25% in 2024 and 23% in 2025. So I'm pretty comfortable using, a 20% number for price to earnings. And so how do we build that into a model? How do we get a range of prices that we would be willing to pay for Tesla? You build a DCF model, and there's all kinds of complicated ones of these, and I think a pretty basic one with a few general a bear, a base, and a bull case is really all you need as an investor, because there is also a risk of having a overspecified or too detailed of a model to where you have this thing called false precision, where you think you're more accurate than you're going to be. Like, none of us truly know what's going to happen. Okay, we're doing price to earnings. We're going 5 years out. And again, we talked about in that model, in the analyst expectations, how 20% revenue growth is kind of what they're expecting. They're actually expecting 24% growth over the next 5 years, essentially, on average. So let's do 24% growth rate. Shares outstanding. Shares outstanding have grown at 6.45% over the last 5 years, but I think that's going to be lower. But I think it's going to be significantly lower. I think it'll end up around 1 to 3%, and actually they'll probably buy back shares, so it could be even flat or down. We'll see. But we're going to use 5% here. So that means they're going to grow shares outstanding by 5% per year. That actually makes the stock less valuable, because every share that's out there right now is going to be worth less if they have more shares in the future. So we're going to go at a price to earnings ratio of 20. Discount rate, this is kind of like the return that we're looking for. I look for 10% per year. I pretty much just use this for everything. If a stock is super risky, you'd go higher. But anyways, this will give us our fair value, right? And so if we think we're going 5 years out, earnings are going to grow at 24% per year. They're going to increase shares by 5% per year, and it's going to have a PE of 20. The fair value, what you would pay for the stock today, is 101, and that's down 10% from here. The future stock price, this is out to 2028, would be 162, which is a 44% gain. And if over that entire time, that would be a compound annual growth rate of 7.58% per year. That would basically be the investor return per year. Now, what could change? Well, if it's growing that fast, it could trade at a price to earnings ratio. We'll go like long-term S&P 500 average of 16. If so, that brings the current fair value down to 80. I don't think that's a realistic scenario, so I'm comfortable with 20. So I'm comfortable with 20 right now as the bear case. I think if anything, it's going to trade at a higher price to earnings ratio. So we'll go 25. If you believe it's going to be 25, then the fair value is actually 126 a share today. And the future stock price would be 203 for a compound annual growth rate of 12.5%. If you think that it's going to get a PE of 30, then fair value today is 151. Future stock price is 244. Compound annual growth rate is 16.67%. Okay, let's go back to 20. And let's just say that price to earnings ratio is 20. Earnings growth rate is 24%. But they actually keep shares outstanding growing at 1% instead of 5%. Well, then right there, you have a fair value of 122, future stock price of 197, and a compound annual growth rate over the next several years of just about 12%. Okay, now let's keep shares outstanding growth rate at 1%, but let's say they can grow earnings at 30% per year and still get that 20 PE. Well, then the fair value is 37% higher. Compound annual growth rate over time, 17%. Now, let's say we're bearish here and we think that they're only going to grow earnings at 18% per year. Well, if they do shares outstanding at 1%, gets a PE of 20, then your fair value is 95 for a 15% downside from here. Future stock price is 154. And compound annual growth rate is 6.4. Only thing I ask you to do if you like this video is like the video, hit a thumbs up. That helps more people find it. Hopefully this is quality content. Subscribe to the channel so you get more of these high quality videos. And then just check out the description down in the videos. I share links to my other work, a free email newsletter, and different stuff like that. Thanks a lot.